All right, so we're going to talk a lot about the income statement today. I do want to kind of review the things we talked about in the videos from last week, and also just the general income statement without OCI and EPS and other issues. So first, we're just going to look at a case from the Chapter 4 problem set. It is case number 5, and it has some a little bit more involved parts to it. Let me get it to focus in here. There it goes. It has a few parts that are distinct, just in terms of being able to discuss some pieces of the income statement again and just review those concepts. So the very first, it basically, so it gives us an adjusted trial balance, um, but just a portion of one. So it just gives us the very bottom section of an adjusted trial balance. But, one of the things that I want you, and hope that you can sort of recognize or understand is that if we're on an adjusted trial balance, that means that we have all expenses, revenues, gains, losses recorded for this period. So they're already recorded and in these account balances. The only thing that remains for us to do at this point in the accounting cycle, if this is an adjusted trial balance, would be to close out all of these items into retained earnings and update the retained earnings balance. Right. So this gives us all the income statement information we need to prepare an income statement. We just have to put it in the right order. And that's what the first piece is asking you to do. It asks you to identify what the gross profit, the tax expense, the operating income, and the net income are for this particular company. So we'll jump on that task first. Again, the easiest way to show work for a problem like this is just to give me an informal income statement. And don't do it. My advice, and this is just coming from my perspective and how I like to lay it out, but also I find that the students who lay it out vertically tend to do much better than those who lay it out horizontally. And I don't know why, not sure. I mean, it really should be the same thing, but it just seems to work that way. So I encourage you to use a lot of that essay box and lay it out vertically, for whatever reason. Hopefully, it'll help you do better. All right, so the first thing we got is sales revenue, and that's always at the very top of our income statement. Here it's 1,875,000. So one thing I want you to check, always with if you get a sales revenue figure, make sure you check for contra accounts. So contra revenue accounts in particular. And the two contra revenue accounts that you have to remember to check for are sales discounts and sales returns. If either of those are listed among the adjusted trial balance accounts, then you're going to need to subtract those from this amount because they are the contra accounts to sales revenue. We hold them separately in the accounting system, but then we report them all as one number when we go to present financial statements. So looking through this information, there are no contra accounts for revenue, no sales discounts, no sales returns. If they were there, we would just subtract them off this number. They would have a debit balance and they would be reported among these other accounts because these accounts must be closed. They are attached to a revenue account, right? They make no sense without a revenue account. If we don't have a revenue account to subtract these from, they have no reason for being. And so they are closed along with all of our revenues, expenses, gains, and losses. Um, so since I don't have any to subtract from, I can take that as it is. Then we have the very next thing we would want to report on an income statement would be our cost of goods sold, because we know that that's the next piece. We got to get our cost of sales right after we list our sales. And so that's 780,000. And if there's no cost of services or, cost of sales listed among the rest of these, then we can just take that as our gross profit. And the gross profit here would be yeah, 1095. 1,095,000. All right. Make sure I get my calculator out. I had a mental that. My my brain calculator is not working too fast right now. All right, so we got our gross profit. The very next thing we want to start attending to are operating expenses aside from gross profit. I'm sorry, aside from cost of goods sold. So these would be the expenses that we tend to run into every period for the company. Now, remember, most of the operating expenses are going to be SG&A, but there are a few operating expenses that are outside of SG&A. So I will list them just separately. We would have selling, general, and administrative, and I will list those out beneath these just to draw attention to what's usually contained in that and what's usually reported separately. In this case, utility and rent expense would be an SG&A. So that is 125,000. Salary expenses and SG&A. Very normal routine expense for the company, 375. Looking through the rest of these. None of the others are very common SG&A expenses. So let's go through what we have left. Retained earnings. This is not an income account. This does not go on the income statement. We can disregard that for now. Impairment, oh, sorry, depreciation and amortization. All right. This is an operating expense, but it typically is not listed with SG&A. We would report that underneath gross profit, just separate it from the SG&A pieces. Salary expenses 375. I'm not sorry, salary. Depreciation and amortization 35. And then when I combine these two and total them out, that's $500,000 of SG&A in total. Impairment of discontinued operations, that is not something that we're going to find in the operating. Of course, the discontinued operations should flag you that that's going to go further down the income statement. Gain from the sale of a fixed asset. This is something that would be operating. Um, it's distinct from the gain or loss on the sale of an investment because that's related to investing activities. If it's the sale of a fixed asset, the reason why we incorporate that in operating expense is because fixed assets are used in operations. They are operating assets. So they're used in the company's operating activities. And since they're used in the production of the company's sales revenue, they are considered an operating asset instead of an investment, which is clearly an investment or an investing activity of the company. So this is a gain, a positive amount, and definitely want to make sure that I recognize that by putting my negative expenses as, in parentheses, just to give myself that heads up when I'm calculating, make sure I don't make a silly mistake and, subtract all of these when this is a gain versus expenses here. Interest expense is not an operating expense. It arises from our financing activities. And so that goes along with investing items. Restructuring costs is one of those operating assets. Sorry, operating assets. It's an operating expense where the company is redefining, streamlining, making itself more efficient, maybe laying people off, shutting down departments. But that is not necessarily going to be a discontinued op qualifier. That goes as operating expense, separate from SG&A. And then we have the loss from the discontinued ops, also a discontinued op disclosure. Tax expense, nope. Dividends. Also, dividends do not go on the income statement. If this were dividend revenue, like the dividends I was paid from a stock investment that my company has, then it would be under the investing or the non-operating section of the income statement because that is a profit that was obtained from my investment. But this is not dividend revenue. And the way you can tell is, well, this would have a credit balance if it were dividend revenue, right? This is dividends paid to my shareholders because it has a debit balance. And so dividends paid to my shareholders are not on the income statement. They close into retained earnings. They do affect equity, but they're not affecting equity through the income statement. All right, so just go back through these, the ones I haven't used, make sure I didn't got the gain in there, just didn't cross it off. Interest expense, make sure I didn't lose anything. All right, this looks like all the items I need to consider now for operating income. Right? And remember, the easiest way to remember that this is operating income is that all of these items that I've listed so far are operating revenue, um, the largest cost of operating revenue here, and then these operating expenses and that gain. So combining all these together gets me, so do the calculation real quick. 375,000. And this is my operating income or income from operations. They're the same thing because this isn't because of one word difference, and that's it's not income from continuing operations, right? That's a different thing. But income from operations or operating income describes what I'm arriving at in this subtotal. Right? So these are the two that usually are watched by investors a lot because these are the items that the company tends to have a lot of control over within its business model. These also tend to be things that are recurring quite frequently and are generated as a source of doing what the company does on a daily basis, what the purpose of the company is. After this, we move into our other income, also sometimes called not or called by me anyway, non-operating income to distinguish it from what came above. And I do like that idea of calling it non-operating income because now by saying non-operating, what we're really drawing attention to is the other two corporate activities, which are financing and investing. And if a gain or a loss or an expense and revenue seems like it came from the company's decision in its investments or the company's decision in how it finances its operations, then that's the indication something should go down here. Remember again, this is not a huge list of things that we tend to see a lot of. So if you're putting a lot in there, you got to have good reason too. The discontinued operations, this is not going to be a portion now because we're still working with the continuing operations of the company. At this point, the interest expense does get put down in this other income area simply because interest expense would indicate a cost that arose from financing by borrowing money, 40,000. Let's see, we got that interest expense. The loss from disc ops is also, again, going to be in its own section with disc ops. Tax expense will follow this section, but not yet. listed, and that's all of them. Remember, interest revenue would go here, dividend revenue or unrealized gains and losses from trading securities would find its place here. Um, the gain or loss on the sale of an investment would go here, but we just don't have much in this particular example. That brings me down to 335, and that is my pre-tax income. All right. Now I take the tax expense from this. At the very top of the page, before the adjusted trial balance was given, it said that they have a 40% tax rate. All of these are pre-tax values. So we're taking that tax at 40% here, figuring out how much expense that correlates to. So we take 335, multiply it by 40%, and that's $150, which brings us to 185. This is because we have discontinued operations, income from continuing operations. Right? If we did not have disc ops, if we had no discontinued operations, then this would be net income and then we'd be done, right? But we do have discontinued operations. We have impairment of the discontinued operations, and we also have a loss from the discontinued operations. Remember that these are pre-tax values. And then also remember, we worked through case three, I believe it is, case three, which gave this to us in a different way. Case three didn't just give us the impairment, the pre-tax impairment loss. We had to calculate it from looking at the book value and the fair value of our net assets of the discontinued op. It also didn't just give us the loss from disc ops. It actually just gave us a revenue and expense. And we had not a loss in case three, but a positive income. So this is a little different. It just gives you those pre-tax amounts rather than having you calculate it. Don't be thrown off by that. You got to identify and know what numbers you're getting and what they mean about where you are in the process. Sometimes I'll have you calculate this, sometimes I'll just give it to you. So in this case, the impairment 175, this now starts my discontinued operations section. I'll do it all in green just to kind of differentiate it. We do have the impairment loss, but remember that is pre-tax. And we need to express our impairment loss net of tax. So while the pre-tax impairment loss was 175, we, as I showed you before, if you want to take this approach, I think it probably helps those who don't necessarily like dealing with percents or math. It puts the tax effect over here with the 40%. So I can, and it's good to know both of the things, the tax effect and the net of tax amount. We don't even need to multiply that by 60% anymore. We could just take 175, subtract off the 70, and we get that the net of tax loss is 105,000. Still a loss, but taxes reduce both losses and gains. It took my loss from 175 down to 105. Because essentially, because of this loss, I'm not paying taxes on $105,000 of this amount of profit. That's why it quote unquote shields taxes. Um, the loss on the discontinued operations, this just came from basically, remember, think of this amount as the result of an income statement for just the disc ops, right? This is just how much more expense than revenue the disc op made. And so 85,000, again, we need to take taxes from that. So I take 40% of 85, and that should be 34, I think, but let me make sure. Yep, a $34,000 tax effect. And net of tax, we have a $51,000 loss. and net of tax. So we're taking the net of tax number, subtracting that since it was a loss. So in total, we're subtracting 156 from 185, which is 29,000. That should be my net income. All right. So let's check to make sure that we didn't forget anything. I'm putting little stars by the other subtotals that are important. All right. Just gonna check through, make sure everything got included where it should have been and for the amount. When it 1,875,000 sales revenue, yep. Depreciation and amortization coming in at 35,000. That's true. Impairment 175, stripped of taxes. 70,000 is the tax. That's the net of tax. All right, we included that appropriately. And then keep checking through these. 375. Salary expense was there. The gain on the sale of the fixed asset, 25, positive. 40, interest expense. Restructuring, 210. Got that. Utility and rent, loss. Utility and rent was 125. Yep, included up here. The loss was 85 and included there at 51 after we stripped tax out. Utility, we got that one. Tax expense, we took a tax expense. Cost of goods sold, 780. All right, looks like everything's on board. Everything is as correct as I know. Let me check this one more time. All right, so the tax expense is incorrectly calculated. I knew something was incorrect here. Some 29,000 didn't ring a bell from my memories of what the correct answer to this was. So, 335 times 40%. If I had written this out, it probably would would have rung an alarm bell a lot faster. Is actually 134. All right. All right, so that adds back 16,000 essentially because I subtracted 16,000 too much. So that would mean that my next should be 200 yeah, 201. This stays the same, doesn't affect the my mistaken tax expense doesn't affect anything I did with the disc ops over here. Stripping out their tax it was calculated correctly. But 201 minus 156 in total discontinued expenses gives me 45,000. All right, so now that is correct. Apologize for the mistake. I even have that whiteout tape stuff. Who promised that? Oh well, doesn't want to work for me right now. Okay, so this is the entire thing. Then we just need to fill out what we have here. Okay, these are the subtotals from the from the multi-step income statement derived from the adjusted trial balance. So my gross profit would be 1,095. My net income is 45. Tax expense in this case is just asking you for what's on the multi-step income statement. 134 would be what's reported as tax expense on the income statement. I do want to note that even though it's not stated, because explicitly stated, it is a multi-step income statement disclosure. This is for the continuing option, the continuing operations of the company, but excludes disc op tax effects. And we're going to come to that in just a second. I just wanted to say that so it's perfectly clear what we're doing in a bit. Operating income, take that straight from here, 375. All right, so we're good on that piece. The next asks us to determine the ending balance of retained earnings after closing entries are made. So you don't have to do all the closing entries here. I didn't ask for closing entries. I just asked for what the retained earnings balance would be after they're done. And if you can do it kind of just understanding the process, remember, we're going to close all of these credit accounts with a debit, and we're going to credit income summary. We're going to credit all of these debit accounts, and then we're going to credit all these debit accounts and then debit the income summary. Then the income summary, because we've just taken all of these accounts here, except for retained earnings and dividends, all the accounts between them, and combine them together, that's just going to give me net income, which was $45,000. So you can kind of skip ahead to the step where if we were doing closing entries, this would be the income summary, and it would have come out to $45,000 credit after revenues and expenses are closed, which means that we would then need to debit it 45,000 to close it, and the credit we would make to balance our debit to the income summary would be to retained earnings. And so with a retained earnings T account, really you have a beginning balance, which is given to you here, 753. And since we had net income, not a net loss, but we had income of 45,000, that would be a credit in the income summary, closed with a debit, and then credited to retained earnings. So we're just shifting that income, adding it to retained earnings. And then our dividends would be closed by crediting dividends because it has a debit balance right now at 250,000 and debiting retained earnings. So then the ending balance retained earnings, now that we have this income statement plotted out with net income, would be 548,000 after I show the effects of both increasing retained earnings by net income and reducing it by dividends. So there's your answer to the second one. The third question talks about the tax expense account. And that's why I wanted to draw your attention to the fact that this tax expense is just the tax expense from the continuing ops. Right? It's the tax expense we would see clearly labeled as tax expense on an income statement, on a multi-step income statement, right before income from continuing ops. So remember that comment I made about the taxes from discontinued ops not being a part of this. So we have these two continuing operation discontinued operation expenses. They are not listed in these numbers here, right? They were separated out on the adjusted trial balance. They were distinct from these other pieces. This 134 is just a tax that arose from all of the continuing operation portions of the company. So these tax effects are not in my $134,000 tax expense. So the way the question is, the amount of tax expense in the unadjusted trial balance, the question marks up here, would be the total amount of taxes deducted from net income. It will not equal the amount disclosed as tax expense on the income statement because of the disc ops. So what I want to know is, since this is the ledger account balance of tax expense, this ledger account it's not the income statement. tax expense item. This is a ledger account. It's on a trial balance, so it has its own T account. It would include both continuing and discontinued operations taxes. So, how do we back that out, or how do we figure out how much tax expense there should be in there? Basically, if it has to include both the continuing and the discontinued operations taxes, we know that we have continuing operations tax. We already figured that out. We already calculated it. It's the amount that we had on the income statement, which was 134. This is tax expense. All right. Now we look at the decomposition of our pre-tax amounts when it came to the disc ops. 175 had a $70,000 tax effect, and the net of tax expense was 105. So again, it reduced this expense from 175 to 105. This one reduced the loss on operations from the disc op from 85 to 51. So these are actually tax rebates, right? Or tax savings. They're reducing the losses here. And so from our discontinued operations, if this is an expense, these guys are doing the opposite. They're reducing our expense. And in total, they're reducing it by 104. So then overall, the total amount of tax felt by the company is 30,000. This is a tax expense net, if you will. But it is the balance for tax expense ledger account. So basically, we're taking the ledger and we're saying, yeah, there was in net $30,000 of taxes, but 104 of that is from a tax rebate on the discontinued ops. 134 of that is taxes on profit from our continuing operations. If you want to check that that is the complete and accurate tax, remember net income is our total flows after all taxes have been taken out, all expenses, everything. So if net income, we're just thinking about the whole company here, $45,000, that's my net of tax amount. And that's the net tax amount, net of tax amount for the entire company. Well, I had to take an amount, a pre-tax amount, and multiply it by 60% to get there. And if I want to go back to that pre-tax amount, I divide it by 60%. That's $75,000 pre-tax. And then applying the tax again, I get $30,000. So that's this is just like a check, okay? A way to check our work. This tells you exactly how the 30,000 is arrived at because we had 134,000 identified as our income from continuing operations taxes, whereas this is the tax effect from just our discontinued operations. Essentially, it was a big old rebate because in this problem, our discontinued operations are both are just losses adding to loss. So it reduced the tax expense from all that loss by 104,000, resulting in $30,000 of tax expense in net for the entire company. And then verifying that right? Checking it by saying, well, is that the amount of tax I would expect for the whole company, including both discontinued and continuing operations? Well, yeah, it is. If this is a tax effect, I could go at it either way. I could either take that, divide it by 40, multiply by 60, I get our net income, or take our net income, divide it by 60%, multiply by 40%, and get the tax effect I calculated. Okay. That's probably the most confusing part of it, but I just want you to understand how that works. And there's a distinction between the tax expense that's reported on the income statement as the line item tax expense, right? The amount that I just tossed down here that was mistaken. That's not all of the tax effect of the entire company because the disc ops are still part of the company. All right. And then that last piece, this is talking about the profit margin and how it's connected to sales. Basically, the profit margin is net income divided by sales. It's a measure of what percent of my sales dollars are turned into net income. Because if we think about it, right, we start off at a large number and then everything else, more or less, except for a couple of things, are eroding away at that sales number. All of the costs it took to make that amount be positive and in our court. So if, for example, the sales profit margin is 10%, that means that we have 10 cents of every dollar of sales becoming net income. That basically it takes us 90 cents to get a dollar of sales. And so 90 cents provides 10 cents of profit. So using this, I ask you to look at this income statement we made in two ways. To look at it overall with the discontinued operation, and then look at it without the discontinued operation, and then make a conclusion as to whether it was wise to discontinue the discontinued op, right? Just from a sales profitability perspective. So it should be pretty apparent that it was a good decision. I mean, mostly because it was just bringing in loss. It just brought in losses here with the impairment and the operations. But to show it completely with a profit margin, we take the $45,000 net income and divide it by the $1,875,000 of sales. This is with discontinued operations. And then if we wanted to see, well, how is this company going to do without the disc ops? We'd look at a very different amount. We'd look at the income from continuing operations because this is net income for the continuing part of the company. So we would have 201,000 divided by 1,875,000. So this would be just with the continuing operations, so without discontinued operations, and what those two ratios are. So if we take the 45 and divide that by 1,875,000, that is 2.4%. And we take 201 divided by 1,875,000, that's 10.72%. So this is the clear winner, right? It was wise, most likely, to discard the discontinued operations because when this company has those in tow, they're having a lot fewer dollars of sales translated into profits for the company. So this is a real simple analysis using profit margin. All right.